Right, hello everyone, it's Jasper here. Looks like we've got a few stragglers still coming in, but we're pretty much kicking off right about now. Should say right here at the start, should you have any questions at any point, just send them through to this questions box. I'll do my best to answer either at the time or just towards the end of the webinar. Probably what we'll do here is we'll go through some of the kind of main material, which we'll be recording and putting on YouTube afterwards. And then should there be any desire to look through some current price charts, then, send me through some examples of what you'd like me to look at. We can discuss that a bit, see if there are any decent kind of RSI examples there, and if so, what they might imply. So I think you've probably all had a chance to read the risk warning at this stage. This is the title of our webinar today. It's Trading with Technical Indicators and RSI. So the bulk of this webinar is about the Relative Strength Index indicator. But I also wanted just to, at the start, give you a bit of a flavor as to my interpretation on indicators and how they're best used in technical analysis. So this is what we're going through today. What is the best indicator? It's just a classic question that we all ask when we first start trading. I certainly did. Most people I talk to who are beginning trading ask that question. Is logical enough? Second question, how many indicators should I use? Again, logical enough. It's a question that needs answering, but as you'll see, the answer is not always as straightforward as we'd like. What is the RSI indicator? A little explanation as to what it is. There is some maths behind it. I'm not going to heavily go into the maths. There's not much point, but I can explain what it's trying to do. And then obviously we'll talk about ways of using it. So the title of the webinar is 5 ways of using the RSI indicator. So we're talking about some of the traditional ways and new ways, and then just how to start applying those, and again, any Q&A throughout or at the end. I'm hoping this won't take up too much of your lunch break today, so we'll try and get through this. I'm not trying to write a book on RSI here, but hopefully it gets across some key ideas, maybe something a bit different if you're already using it. So what is this best technical indicator? How many people have asked that question? Everyone. Hard truth? None of them. I know it's an annoying answer, but basically price action is the key to technical analysis. Indicators should supplement the price. What do I mean by that? Or what's the idea? Why even say that? Indicators, they're all mathematical indicators based on price. So it makes sense that just the pure price itself should be the first consideration, and any second derivative of the price, i.e. something that's been made up from the price, should be a second consideration to help you maybe clarify or clear up what you're viewing the price. So price action to me pretty much includes candlestick patterns or bar chart patterns, the use of support and resistance, and analyzing the trend through higher highs and higher lows. It's pretty much the key elements to technical analysis, which those who are fans of naked trading will use just purely those without any indicators. I'm not such a purist. I do tend to like a couple of indicators, and we'll go into that in a minute. So how many indicators should I use? Chaps, this chart is far from ideal. This is just an absolute mess, to be quite honest with you. What are you supposed to interpret from this? What are we trying to achieve? Are we trying to achieve a beautiful looking chart? Not sure I think this is beautiful anyway, or are we actually trying to kind of put together a concise idea about the trades we want to place, or either right now or what we're looking for in the future in terms of setup to place a trade? We want the chart to be clean and simple so that we know what we're looking for. And of course this particular example isn't. So a very clean looking chart here. Can you spot the trend? Clearly up, right? An uptrend, it just starts in the bottom left hand corner, ends in the top right. It's really not much more than that. Obviously there are more clinical ways of putting that together, but ultimately, what your eye tells you in the first millisecond is generally the case. So moving past that, And again, we don't have any indicators on the screen here, and I'm just trying to illustrate a simple point. Look at this E1. So each of these E's are potential entry points. E1, clearly just a breakout of the old high. We had a big run up higher. We don't know what price action was happening over here. Maybe the trend was already going, maybe it was a down move, maybe it was probably more likely a kind of sideways consolidation. But we had a nice little run up higher. Shows momentum seems to have shifted to the top side. We're looking for a breakout for that to trigger our trade. Now maybe we'll wait for a close above that line. Price pulls back down to the previous low. If you're either using this little pullback area here as a low, or if you're using this low down here. Maybe if you had a very tight stop under these lows, you'd actually be stopped out. But then we form another high, and then we get another close above it. We either enter up here, quite high in the trend based on the close, or maybe we wait for a pullback, and you see how this high here, I can't draw everything on this chart, pulls back to this high, and then we set off again. And again, we got another entry opportunity. Maybe we have buy stops going, so we actually do capture the trades fairly close to the old peaks. And again, the trend continues. We get a breakout again. We get a pullback again. We get another entry opportunity. And say we don't even like trading breakouts. Maybe we like trading pullbacks. So another potential opportunity is not only was E3 an entry opportunity here, but as an old key high, price actually pulled back there once but twice as potential entry opportunities up here. And then again, the trend breaks the old high. We move to the top side. And then it looks like towards the end of the chart, where we're sort of, had a big, kind of steeper than we'd previously seen pullback with a bit of a reversal pattern. And then maybe the makings of a double top reversal to reverse that trend. No indicators involved whatsoever, right? And again, you're probably thinking, well, that's a perfect trend. Actually, when I made this slide, it was just something that was in the current price charts. I didn't really have to look too far back. Markets, when they trend, you can generally see the pattern within there. And when they don't trend, it's a bit of a mess. And again, this one is not a perfect range scenario. So, often in textbooks you see perfectly to the bottom, perfectly to the top, perfectly to the bottom. I haven't chosen that here. You can see there are some pullbacks from the middle of the range here. But generally speaking, I think this range was approximately 100 pips in the Forex market. And, again, do we have any indicators on the screen? No. We're purely looking at basically 20 pips within 100 pips is obviously 20% of that total trading range, right? So the idea here is there's no trend, but we're looking for high probability setups within the bottom 20% for buys, top 20% for sells, with the idea that in a range trading condition, mostly the range will continue before eventually on one occasion it will break out. And obviously if you're selling the top when there's a break higher, you lose that trade, but hopefully you've had some winners before that. So moving specifically on to the RSI now. It stands for the Relative Strength Index. It compares the magnitude of recent gains to recent losses in a range between 0 and 100. So making it between 0 and 100 is what makes it an oscillator. It's a momentum oscillator, and it's added to the bottom of the chart rather than overlaid like a moving average or something like that. So that 0 to 100 is useful because we can use set limits to give us an idea as to where the market's position, how aggressively long it is, how aggressively short it is, how neutral it is, can all be judged by that, which number it is between 0 and 100. And sort of the idea is that in a exaggerated trend, gains tend to be a lot bigger than the losses, but when you come towards the end of a trend or you're not in a trend, the gains and the losses sort of equate to each other in terms of sort of candlesticks of green versus red candlesticks. But truth be told, most oscillators pretty much do the same thing. It's all just different maths in order to use some of the same techniques. That said, in my opinion, why I'm doing a webinar on RSI today, it is a little bit special and it has some uses beyond the normal spectrum for indicators. I had a question from David asking what time frame are these charts honestly, David, I don't actually remember. I did prepare this webinar about a month ago. Yeah, the general rule is that any indicator technique is more reliable on a higher time frame chart, but tend to be give less opportunities. So that's the pros and cons of time frames. Do you want more opportunities on the short-term chart, or do you want more reliable opportunities on the long-term chart? That's pretty much your trade-off. So traditional uses of RSI. So you guys may well be familiar with these. I'm sure plenty of you are just doing a bit of a refresher. For those of you who are new, these conditions, these uses sound a bit weird, but they're actually quite simple, and I'm going to demonstrate them in just a minute. So the traditional uses, overbought and oversold, as well as divergence, and then some alternative uses of the RSI, identifying bullish and bearish ranges, and positive and negative reversals. Now, it just so happens that I did a separate YouTube video just yesterday on the upcoming Facebook and Microsoft results, and it's Facebook, I believe, that has a positive reversal in the RSI. So we can see if that pulls off. That's something to check out on YouTube afterwards. Before we get to that stage, this is the overbought and oversold idea. So basically, the idea is that when the market gets over the 70 level, so obviously, as we said, down here, this is the RSI, starts down here at 0, ends up here at 100. Over the 70 level, it's overbought. So between that 70 and 100, it's overbought. Between 0 and 30, it's oversold. So when the market dips down through this 30 level, it's oversold. So idea being that it's just the market suffered a bout of selling, the market's dropped a lot, and it's due a bit of a bounce back. So as you can kind of see from this chart, here we get the price breaks through the 70 level, and it keeps running higher, has a little dip, and then actually runs up and does a little pattern in the price, a little kind of double top pattern here. But you'll notice actually that it dips back through the 70 level, and that's when we start getting more of a sign that actually the market is topping out. So the general rule of thumb when you are using these levels in some way in your trading strategy is that don't immediately sell the market just because it's popped into overbought territory. Don't immediately buy the market just because it's popped into, because it may dip right down to 0 if things get really extreme, and equally 100 on the top side. So what you really want to see is the market pull out of that overbought or oversold condition before you then start looking for the opportunities. So sometimes it works better than others. We had a big run down here from the oversold condition, overbought, but then this oversold condition, we had a kind of little minor bounce back. They kind of grinded higher a bit. But then, as you can see here, nothing's perfect. The market was pretty soft basically at this stage, and I'll talk more about this in a minute. It never reached up to the overbought condition because the market was in kind of selling mode at this point, and it just hovered around the midterm and then dropped again. So there was no RSI signal or based on an overbought level to take advantage of this particular trade. Again, you can't take every opportunity necessarily. So for this particular technique, the market got really oversold again at this point, and then actually this provided a pretty nice entry point with the benefit of hindsight. By the time you get this signal of the RSI being out of the overbought zone, you probably already missed these first 2 candlesticks. But again, you can't perfectly pick the bottom. The idea here is to kind of catch some kind of durable move in the market. So then eventually the market does grind high with not too much in the way of retracement, and actually, as you can see, pretty much comes up to the resistance here that we saw at the start of the chart. And then again, once you hit that, you have that both the price's resistance as well as the RSI coming out of its overbought zone, gives you a bit of a little trigger to sell the market lower. So, word of caution here, if there is a strong uptrend, you can, and certainly people do it, but I don't advise selling within an uptrend. It's just you're going against the flow of the market, and obviously that there where the interpretation in this particular scenario that we're looking at is, ideally you don't want to be selling the overbought conditions in an uptrend, because it's going to remain overbought for a while because people are buying it. It's an uptrend. So as you can see, the market will roll over from the overbought level, but it won't be durable. It won't even get down to the previous low, obviously. So it's difficult to find a price target. And when it does rip the other way, you tend to get these big, like, bullish engulfing patterns, and it will take you right back up to your entry point. So you can kind of go for it. A lot of the time you'll get a scratch, basically a break-even trade, or a few small wins. But, it could just blow completely in the direction of the trend again and, catch you out. And to be honest, to me, in terms of risk reward, it's just not worth it. So switching gears to divergence. So divergence is, there's kind of convergence and divergence, if you like. Divergence is typically the one that will give you more of a signal, and it's how the RSI down the bottom here relates to the price in the top of the chart. So the idea being that you're comparing the kind of swing lows in the RSI to the swing lows in the price. So if price is making a lower low, as you would expect it to do in a downtrend, maybe the downtrend started up here, we're trending lower, but then suddenly the price makes a lower low, but here you see the RSI making lower lows, but then suddenly the RSI makes a higher high, and then breaks above its old swing high like so, matched with perhaps a bullish looking candlestick pattern. Then you can see that actually the momentum is shifted in the market. The momentum turned first, represented by the RSI, and price duly followed suit. So another example here, and you can see it doesn't work perfectly every time. So here was the first example, which obviously I've drawn the nice example that worked. So here, price made a lower low, or a lower low there. RSI made a higher high, higher here. But even though you got a little pop in the market, it did roll over again. I'm glad to be showing you this because not every strategy works perfectly, right? The best strategies in the world have probably a 65% success rate. In my experience, with those with a good risk to reward. Obviously, if you're trying to hit 1 pip and you're risking 100 pips, then you're going to have a pretty good win ratio. But it's not a particularly durable trading strategy in my mind. If you're looking at kind of trading strategies where your wins are going to be more than double your losses, in terms of the size of the win, you're winning 100 pips, losing at 50 pips, that kind of thing, you're not going to get much more than a 60% success ratio. That's because of little scenarios like this. The general technique works, but the market has a mind of its own. It will do. These techniques won't work every time. That's why we use stop losses. But I hope you've got the general idea there in terms of divergence. Now, this is where I've pulled back that, when we were talking about the overbought and oversold scenario in the other chart, and we're talking about this is the uptrend. We don't really want to be necessarily taking these oversold signals, but we do want to be buying all these dips. So how do we do that? Well, we add a new line into the RSI. We were looking at 30, we were looking at 70, but when we see the price trending higher, breaking above, making a higher high, making a higher low, breaking above, making a higher high, higher low, it's in an uptrend, right? That's how we designate an uptrend, moving from the bottom left to the top right. We can shift the level that we're focusing on down from this overbought 30 level up to the 50 line. And you'll find that the 50 level works rather well under certain trading environments. Sometimes it will shift up to a 60 in a very aggressive trend. But 50 is a good kind of general level to say that when you see a kind of some sort of trigger, perhaps a bullish engulfing pattern, candlestick pattern, or a short-term trend line break, or I'm going to have a different webinar actually, as it happens, on different triggers, entry triggers to trades. But if your entry trigger to the top side in an uptrend happens and RSI has just pulled back to around the 50 level, that's often a good value place to be buying in an uptrend. So it's these red arrows here that we're focusing on, the dips to the 50, 55, 60 level in the RSI, rather than the hardcore oversold condition, which just isn't going to happen in an uptrend, right? Because again, it's going to be more buying than selling. You're going to be more overbought than oversold. You're not ever going to get really oversold. But it is worth noting that the trend continues here. If I extended this trend line, you'd have a bit of a trend line break. Then we actually take out that support here, and a little pre-warning. Trend line was probably the first signal. Second warning was that we dropped through the 50 level. And then probably third warning, when we drip down to this 30 level, is actually we've kind of shifted out of that uptrend environment. We've now drifted into a sideways environment, where you can see that over here the price got capped by that old high. So the trend may resume to the top side again, but we've just shifted into more of a sideways trading environment. And so you can see that through the movement to through support, which typically you wouldn't expect to happen in an uptrend. But also RSI adds a bit of evidence to that idea by moving down to 30 and not holding above the 50 level. Okay, we just had a question from Ed talking about down here in the indicator. It has close and 14. 14 is the periods that you're setting the indicator to. So you can do it in the LCG trader, which I base these charts on. Other platforms too. You can generally customize your indicators. So 14 periods is what Alexander Elder, the developer of this indicator, thought worked best. And in my experience, in terms of using these bullish and bearish ranges, I agree with him, and I stick with the default of 14. If you want more kind of, basically, if you turn it down to 10 or 5, for example, you'll see much more erratic moves. The indicator will become a lot more sensitive. If you cranked it up to 20 or 50 even, the indicator would become a lot more smoothed out. You'd get a lot less signals, but theoretically the signals you'd get would be more categoric, perhaps stronger. But obviously longer time frame in nature, using 50 periods of data instead of 14. Then close, I'm not 100%, but I assume that's it's basically using closing prices rather than intraday prices, which tend to be less reliable. So it can be the close of the 1 hour period, or it could be close of the day. I hope that makes sense. And so the idea now is that you've got a few of these techniques under your belt. You've identified, you've got the idea of divergences, overbought, oversold, using. Oh, sorry, I thought I skipped a slide there, so I suddenly thought that seems quick. Okay, before we get to how we use them, one more technique to go over here. Positive reversals and negative reversals. Now, basically one is the opposite of the other, so I've just shown positive reversals on the screen here, and again it's our same chart that I've plucked out, and you can kind of see what I'm hoping you're also picking up behind the scenes here is that if you can combine a few of these different techniques together, then it really adds strength to what you're doing and adds strength to the probability that your trade works out. If you just use one of these techniques in isolation, you're going to be pushing at the 50% random success rate as to whether it actually works. To really give yourself an edge in trading, you need a couple little techniques under your belt and use them in coordination. And when they both happen, probability of the trade working out is that much stronger. So you can same chart again. where I think we were originally looking at kind of breakouts, then we looked at overbought, oversold, then we looked at the trend ID using the 50 level. Now we're looking at positive reversals, and so it's in a way it's opposite to divergence, which is a little bit confusing in a way, but it's not quite. So in an uptrend, when it comes in an uptrend for divergence, we'd be looking at the peaks, the swing highs. When it comes to positive reversals, we're looking more at the lows. So the idea here is that price has made a higher low, as you would hope in an uptrend, but the momentum, as represented by the RSI, has made a lower low. So even though the momentum is falling off a bit, the market is strong enough to put in a higher high. That's the idea here, that's the concept. And you can see this working on a few occasions where I've got a little trend line through connecting these lows here, and at the same time the momentum has just made a lower low. And we see this happening on a few different occasions, and when those two things are happening in sync, then it's again a little idea that maybe the price is due a rebound. So the opposite would be the case for a bearish reversal where, a negative reversal, where that would be when you're in a downtrend, and instead of focusing on the lows like you would with divergence, you're looking at the highs. And then you're looking for an example in a negative reversal where price has made a lower low, but the price has made a lower high, and the price has made a higher high. But then if we switch back to this chart, basically I've given a few little examples here just based on a chart that I plucked out of the platform. But really the key is for you guys to go away and not believe me that this works, but to actually look through some examples in your price charts and give yourself some confidence that these particular techniques are in fact worthwhile using. So it's obviously one of the problems in trading is you need confidence to trade well, but you get confidence through trading well. Bit tricky, right? So one of the ways around that is that you can back test your charts, feel confident that the technique that you're using does work, you've seen it work in the charts, and then you go forward and forward test it, place trades in a demo, or place ideally smaller than perhaps your normal risk tolerance in a live account, to really put your emotions to the test. So that is it. That's that's the bulk of what I was looking to show today. Again, fairly short and sharp. I think we're just a shade under half an hour here. So I'm going to say thank you to everyone. I'm going to stop the recording. And then for those who are attending this live through the webinar, if there are any charts you'd maybe want me to go and look for any examples of this through, please just let me know. But I do understand it's lunchtime, so you might want to scoot off. Thanks again, everyone.